Let me show you three numbers right now as of today. Gold is at all-time highs, around $5,000 an ounce. The S&P 500 is basically flat for the year, while BTC is down 47% from its October peak of around 125K. Alts like ETH, Sol, and others are beaten up even harder. But that could all be about to change because BTC and crypto more broadly is somehow outperforming stocks and gold since the Iran war began. Now, yes, it feels great to see BTC reclaiming 75K and Sol finally in the 90s. But before we even talk about massively deploying into crypto right now, we need to understand that gap between these three asset classes. So why are metals at all-time highs while the stock market is flat and crypto had its worst fourth year in a bull market ever? Well, it turns out the answer is quite simple, and I'll show you what the experts think in just a second. But we also need to talk about that $16 billion figure, because that's the amount of stablecoins on-chain, both in Solana wallets and on protocols, not in banks, not in TradFi accounts, it's capital on-chain. And that's the signal for people who chose this ecosystem, who stayed through the extreme fear, and they now are waiting to deploy that capital. That $16 billion is waiting for something. This week, we're going to find out if it arrives soon, or as Professor Scott points out, after a $10 trillion crash. We all know it, 2025 felt broken.
So 2025 kind of sucked.
Yeah, it was shit. Every day, somebody's slotting the market while, tech stocks go to new highs, everybody else is having a party. And we just feel like the really uncool kids at the party have been watching from the outside while everyone's having a good time.
And I want to be straight with you about why, because it matters for what comes next. The narrative going into last year was straightforward. Liquidity was stabilizing, financial conditions were great, ETFs were live, the institutions were coming, some were here, and it all pointed in one direction, up. Then October 10th happened, $28 billion of damage in a single event. And you'd be right to think October was a long time ago, surely we're over it by now, but
people are still licking their wounds, there's less capital in the market, and, gold and silver had a big run. Tech stocks have had a big run. So speculative capital moves for the place with the fastest rate of return. And so speculative capital hasn't come back in here yet.
And the disappointment is doubled because that 4-year cycle theory told us that 2025 would be a massive year for crypto.
Over the long run, we know all of this stuff goes up because of debasement. But the nuances of what market, who'd have thought that the fourth year of a crypto bull market would be negative?
Now, people like Raoul Pal and Cathie Wood think that what we're seeing in crypto post-October 10th is structural, because when the extreme volatility hit and the market-making systems broke down, liquidity vanished. Order books thinned out, and forced liquidations cascaded and created this nasty price action that we never really saw coming. So did October 10 destroy crypto? Well, look at this chart, just to really show you how bad things got after October 10th and that $28 billion damage that we had in a single event. We're down 47% from the all-time highs, and around $1.5 trillion in total crypto market cap was wiped. And you're right to think $28 billion in forced liquidations doesn't sound enormous compared to, let's say, traditional markets. Because let's face it, JP Morgan processes $10 trillion in transactions per day. But in crypto, that is a significant overhang because it creates a constant downwards pressure, even when the news flow is genuinely positive. And again, this is worth reiterating. The news flow has been remarkably strong.
And I spoke to Coinbase, Binance, I spoke to all of the sovereign wealth funds, I spoke to Bitwise, I spoke to, you name them. Everybody's like, all we've got is inquiries, all we've got is onboarding, all we've got is financial institutions building on rails. It's like, okay, we had a good CPI print today. The market just went, nuked again. So it tells you there's an extraneous factor. There's not enough liquidity around, which doesn't help. So crypto gets hit. And then there's this overhang thing.
Okay, so 1010 was terrible, and Raoul says that glaring disconnect actually signals a liquidity distortion rather than a thesis failure, and that markets often look weakest right before those overhangs are cleared, which is obviously good news for us. So let's take a look at what the smart money is actually doing, because something very, very different has been happening at the institutional level. And it's that part of the story that the price charts alone don't really tell you. Spot Solana ETFs launched in July 2025, and since then, the price of Sol has fallen by roughly 57%. And yet, those ETFs managed to accumulate $1.5 billion in total flows. Nearly 50% of those ETFs are 13F filers, the large institutional investment managers who are required by law to disclose their positions. Think of names like Goldman Sachs, Morgan Stanley, Electric Capital, Multicoin. Big, big names. And as the Bitwise CEO Hunter Horsley reminds us, These aren't traders chasing short-term momentum. They're long-term oriented buyers. These are firms with investment committees and fiduciary obligations, and they're still buying a 57% drawdown. Bloomberg Intelligence's James Seyfarth noted that the 50% known holder rate for Solana ETFs is quite striking because it took Bitcoin ETFs multiple quarters to reach that level, while Solana got there in just months. We also know that Bitwise's BSOL alone regularly pulls in tens of millions of dollars of inflows, where the total net flows, as you can see from the ETF tracker on SolanaFloor.com, is now sitting at around $1 billion. Now, I want to zoom in specifically on Solana here, firstly because it just celebrated its 6th birthday, so happy birthday, Solana, but also because something rather interesting is happening at the network level that, again, the price chart is completely hiding. Look at this. While crypto prices have been grinding lower, Solana has quietly become the dominant blockchain across almost every metric that matters. Think DEX volumes, stablecoin activity, transaction counts, active addresses. These numbers are insane for a network that's only 6 years old. $496 billion in on-chain transactions, $2.6 trillion in DEX volumes, and over $16 billion in stablecoins. That number does fluctuate, granted, but it is the number that we keep coming back to. This isn't a blockchain that's preparing to be relevant like some of these emergent, high-performant L1s that we're seeing out there. Solana is already the most active financial settlement layer in all of crypto. And that $16.23 billion tells you something very specific. It says that people who moved capital into Solana didn't leave when the price fell. They are still very much here. That's a very different signal from a network that's bleeding users because it shows that the participants have serious conviction. Now, we saw plenty of people on CT saying that they stayed when Solana crashed to $8, so $80 wasn't really enough to rattle them. And today, we also have regulation moving on our side, unlike back in 2022 under Gary Gensler's combative SEC regime. Now, the Clarity Act could be a watershed moment for massive deployment. That's why $16 billion isn't just a number. It's more of a measure of how much patient capital is already positioned for that moment. Look at these 3 charts here. 1, we have over $300 billion of stablecoins today. 2, over $8 billion was issued in the last month alone. And 3, only $16 billion or so are currently on Solana. However, Solana saw $650 billion in stablecoin volume in February alone, more than any other network, more than 2 times the previous record. Now, having said that, we also know that over 50% of stablecoins are on Ethereum today, so it's kind of open to interpretation whether that's bullish or bearish for Solana, but most analysts would likely point to the growing stablecoin adoption of Solana and argue that Solana has much, much more room to grow. Here's a prime example for you. PayPal just announced that it's expanding stablecoin payments to a further 68 countries. That's 70 in total. I would argue that's incredibly bullish. MasterCard too is making moves with an announcement today that they'll be acquiring the stablecoin startup BVNK for $1.8 billion. Imagine that, a stablecoin startup valued at almost $2 billion, and the world's second largest payment processor acquires them. Again, extremely bullish. Having said that, I'm not going to lie, it's not all roses and daisies out there because oil is trading at around $100 a barrel. The February jobs report shocked markets entirely as we saw 92,000 positions gone. Unemployment's around 4.5%. We have rising inflation, weakening employment, and all of this points towards stagflation risk. Now, historically, when you ram all of these indicators together, you are looking at a catastrophe. And here's what Scott Galloway has to say.
I think we're on the precipice of like a $10 trillion wipeout.
Whoa. Really? Tell all.
This is the chain reaction here. I think corporate earnings are really impaired as consumers stop spending because some of them will be paying $5 a gallon for gas and their 401k will start to decline.
Now, that chain reaction would indeed be a catastrophe for the US economy in the short term. But then Galloway paints an even darker picture.
By August, the narrative shifts from transitory war shock to holy shit, we may have broken the global financial system. The S&P is off 20 to 40% from its peak. Bitcoin goes to like 30,000.
For now, that seems to be an unlikely scenario, although some people would rightly call that a generational entry opportunity. Now, let's take a second here and zoom out from all that short-term noise, the selling overhang, price of oil, the Fed, the rates, because only then does this structural argument that Raoul Pal made become much clearer. Now, his core thesis is that the global financial system probably requires several $1 trillion of additional liquidity, at least over the next 12 months, just to simply function. And he did mention to SolanaFloor that we're likely getting a $10 trillion debt rollover within 2026, and that would inject vast amounts of capital into risk-on markets like crypto. So the real question that we started with, does that dormant capital deploy now? Is it ready? or does it wait for a $10 trillion crash like Professor Galloway was talking about? Here's what the evidence says. The capital sitting in on-chain stablecoins on Solana survived the bear. It didn't leave during the 57% drawdown, neither did the market cap crash during that oil shock and the wars that are going on. It didn't leave when the jobs report came in weak. ETF inflows have continued as well. That tells you something about the conviction behind it. And I guess more importantly, at the institutional level, conversations have been accelerating, as we heard. Raoul Pal's conclusion from all of those conversations is also clear.
2026, probabilistically speaking, has to be a good year because of liquidity, fiscal stimulus, and all the other stuff that's coming. Regulation changes, and a Treasury Secretary who really understands about the business cycle and how we need to jam it if you want to win the midterm elections. I mean, it's all there, and they're telling it openly.
So that's good news, because what feels like stagnation today could look like accumulation in hindsight, hopefully in the not-so-distant future. Now, Raoul Pal frames this not as the end of the cycle, but more of a coiled spring waiting for some inevitable liquidity to finally release it to the upside. The macro picture also has two binary outcomes this week. A Fed that signals flexibility will give the market a catalyst. A hawkish surprise is going to extend the wait. Whether we see a storm or a bullish surge depends largely on the Fed for the time being. Either way, the structural case doesn't change. The liquidity maths doesn't change. The institutional onboarding certainly does not change. Those guys are here and they're staying. So where does that leave us for the week? Well, BTC tagged 76K and Sol finally broke out of that annoying, boring range that we seem to have been trapped in since the February 6 lows. The Fear and Greed Index finally is out of extreme fear, and despite all the macro noise, Solana's fundamentals and the network stats are better than ever on the week of its 6th birthday. So the question is about how traders and investors are positioned for the coming months. We'll be back for more updates across the Solana ecosystem, so please like the video if you are here. Genuinely helps us reach more people with this kind of analysis. And I'll see you next time for more of the latest.